Hi, you're welcome to my channel. So, in the previous video, we were dealing with a soul system and we only dealt with one assertion, which is occurrency. So, in this video, we are going to finish the remaining assertions. Yeah, so we start. I got new markers and then a new duster. So, let's start. So the format is still the same. We look at the assertion and then its objective, then we look at the key controls, and then we look at the test of controls. In the previous video, I told you that key controls are by management. Yeah, they are set up by management, then the test of controls are by the auditor. The auditor will test these controls that were put up by management. So the assertion that we are going to look at is completeness. So for completeness, like you want to make sure that something is complete. Remember, we are dealing with cells. So they have to make sure that revenue for all the cells that were made is receipted, is invoiced, and recorded in the books of accounts. That is completeness. So the key controls show how they can achieve this objective, how they can make sure that revenue for every sale is receipted, invoiced, and then recorded. So what can they do? The first is accounting for numerical sequence of the goods delivered notes, sales invoices, sales orders, and then receipts. Like numerical sequence of those documents, like you number them, like sales invoice 1, sales invoice 002, 003, like that, you number them. Yeah, so that you can easily match. You can easily match, like in case you are looking for something, you can easily match the sales invoice to the sales receipt and everything. So if they are numbered, it will ease work. Yeah, you like every invoice will have a number, then every sales order will also have a number, every goods delivered notes will have a number, so they can easily be matched to each other. So that will help you to ensure that revenue for all the sales that were made is recorded. So how can the auditor test this kind of control? So here the auditor is just supposed to carry out a sequential check. Supposed to carry out a sequence check on a sample, like they will get a sample of the goods delivered notes, the sales invoice, the sales order, and then the receipts. One sample or two samples, and then they match them to see if they are really matching. Yeah, to see if sales invoice 001 is matching with the sales order 001, things like that. So that's how the auditor can test this kind of control. Just select a sample and then carry out a sequence check on a sample of sales order, invoice, receipt, and then GDNs. That's how that particular control can be tested. Then the second control for achieving this objective is goods delivered notes should be matched to sales invoices. Like every goods delivered notes should be matched to a sales invoice to make sure that everything is complete and nothing is missing. So how can the auditor test this kind of control? The auditor is supposed to just select a sample of a particular goods delivered note and then match it with its sales invoice to see if they are really matching. That's how the auditor can test this kind of control. Yeah, then another one is an open order file for unfulfilled orders to be maintained and reviewed regularly. Like the organization can have like a file whereby they record all the orders that are not yet fulfilled. So that file should be reviewed regularly because they keep fulfilling orders day by day. So it should be reviewed like regularly. So that those that were fulfilled are ticked, and then those that were not fulfilled are left there unticked. Yeah. So how can the auditor test this kind of control to see if it's really working? The auditor is just supposed to inspect the open order file for unfulfilled orders. Just inspect the file. So that is the assertion of completeness. Yeah, this is how they can make sure that revenue for all the goods that were delivered is recorded. Yeah, these are the key controls that can be put in place by management of the entity, and this is how the auditor can test these kind of controls. So the next assertion we are going to look at is accuracy. So another assertion is accuracy. Something accurate, it's something that is correct, something that has no errors. Yeah, that's accuracy. So here the objective is to ensure that sales and adjustments are recorded correctly, something that is correct. You want to make sure that sales and its related adjustments are recorded correctly. So here, like, how can they achieve this objective? How can they make sure that sales and related adjustments are recorded correctly? Adjustments, we have things like receivables, in case sales were made on credit, provision for doubtful debts and then bad debts. We have sales returns, stuff like that. So for accuracy, they have to make sure that sales and related adjustments are recorded correctly. So how can management make sure of this? So they can do that by making sure that sales invoices and approved goods delivered notes are used to record sales. Like they use the sales invoices to record sales instead of using maybe the sales orders. They use the sales invoices and then approved goods delivered notes that show that like that order was actually delivered. The customers received the goods. So they use sales and approved GDNs to record sales. That will help them to make sure that the figures that were recorded are accurate. So how can the auditor test this kind of control? So the auditor's test of control always depends on the type of control. So you can just look at a particular control and then you come up with a test of control, even when you've never seen that kind of control. You just base on how the control is stated. So this control says sales invoices and approved GDNs are used to record sales. So the test of control will be inspect a sample of sales invoices and GDNs. Inspect a sample of sales invoices and goods received notes for their accuracy to see if they are really accurate. Then another control is goods are sold only at authorized prices. Like in order for them to achieve this objective or to make sure that the figures that are recorded are accurate, they have to make sure that goods are sold only at authorized prices, like when they have a list of the authorized prices, so that they do not sell goods at any price. So goods are sold at only authorized prices. So the test of control will depend on how this control is stated. So the auditor will have to examine an approved price list for accuracy and proper authorization. So the auditor will just have to get a price list of all the goods and then services to see if it's accurate and to see if it was authorized by management and those charged with governance. That's the test of control for this. So it depends on how this is stated. Then another control is arithmetical accuracy of cells is checked before recording cells. Like you check for the accuracy to see that there is no error. Yes, so it will help you to achieve this objective. So the arithmetical accuracy of cells is checked before recording the cells. And how can the auditor test this kind of control? The auditor is just supposed to recalculate things. To recalculate to see if everything that was recorded is correct. That's the test of control for that. Then this monthly statements are sent to customers. So this is sent to credit customers. The credit customers that the business is demanding. You send them monthly statements to remind them of how much the business is demanding them and how much they have paid so far. So you send them monthly statements. Yeah. Then how can the auditor test this kind of control? The auditor is just supposed to review the entity's procedures of sending monthly statements. Like how does the entity send the monthly statements? Through email, SMS, or they deliver a document to them. Yeah. So the auditor is just supposed to review the entity's procedure of sending monthly statements to see if it's appropriate or not. So that is accuracy. Yeah. What I wanted to emphasize is that the test of control depends on how the control is stated. Yeah, you just twist around and you'll be like, the auditor will examine to see if this and this is correct. Yeah, there is no logic science. You just twist the control, then you come up with a test of control. We're going to have is cutoff. So the next assertion we have here is cutoff. So cutoff, it is making sure that transactions are recorded in the correct period. So here, the objective is to ensure that sales and its adjustments are recorded in the correct period. That is cutoff. So how can management make sure that sales and its adjustments are recorded in the correct period? If something is supposed to be recorded in this financial is recorded in this financial, not in the next financial or the previous one. So how can they make sure of that? So first is they can make sure that all goods delivered notes are sent to the invoicing section daily. Like every time they deliver, they send the goods delivered notes to the invoicing section so that they can be able to make the sales invoices. Yes, so that will help to make sure that sales and its adjustments are recorded in the correct period. Then another way is invoices for goods dispatched are raised on a daily. Like if they deliver something, they also come up with its invoice on that very day. Yes, so it will help to make sure that sales and its adjustments are recorded in the correct period. Like if you make a goods delivered notes, you also make the sales invoice. Yeah, so that you do not mix up things because there are chances that you can forget. Yeah, or anything can happen, or the goods delivered notes can get lost. So invoices for all goods dispatched are raised on a daily. So how can the auditor test this kind of controls? So here the auditor is just supposed to compare the dates. to see if they match. So the auditor compares dates on the sales invoices and credit notes before and after the period end with those on goods delivered notes and then goods returned notes in the ledgers. So the auditor has to compare the dates to see if they match and if they belong in that particular financial year or not. Yeah. So that's how the auditor can test that control, and that's how cutoff can be achieved. Yeah, those are the controls. That's the test of control. As I said, the test of control depends on the key controls. The next assertion is classification, and it's the last one for the sales system. So the last assertion in the sales system is classification. So for classification, you're just supposed to make sure that transactions are classified properly, like the way they are supposed to be classified. So here, classification, the objective in the sales system is to ensure that sales transactions are properly classified. Like what is supposed to be cash sales is classified as cash sales, credit sales, then receivables, provision for bad debts, stuff like that, sales returns. Yeah. So this is to ensure that sales transactions are properly classified. So how can management achieve this? They use a chart of accounts is used where there is an independent review of the codes. Like a chart of accounts is used whereby they make sure that if something is recorded as cash sales, there was cash that was received. Yeah, then if something is recorded as credit sales, it's also recorded under receivables. Yeah, or they open up the debtors accounts. If something is recorded as a bad debt, there must be evidence that this customer is not going to pay. So a chart of accounts is used where there is an independent review of the codes. So how can the auditor test this kind of control? The auditor is supposed to select a sample of sales documents for proper coding and review the evidence of that coding. The auditor can select a sample of cash sales if they say that these sales were made on cash. So the auditor is also supposed to get evidence of the cash that was received. Was it received by bank or cash at hand? So inspect the sample of sales documents for proper coding and review evidence for that coding. So for this control classification, like these are the answers that are going to cut across everywhere. In case we go to purchases, when we reach when we reach on this assertion of classification, here it will be to ensure that purchases transactions are properly classified. Then this will be the control, and here will be like select a sample of purchases documents for proper coding and review evidence of that coding. So this answer cuts across everywhere. Yeah. You just change this sales where there is sales, you put that transaction that they have said. If it's inventory, you put where there is sales, you put inventory, you put inventory. So this answer cuts across. For classification, it's the same answer. Yeah. If you see it anywhere, just know the control is a chart of accounts is used where there is an independent review of the codes. Then the auditor will select a sample of those documents for proper coding and review evidence of the coding. So that is it. So that has been the sales system, and its assertions, and then the key controls and test of control. So we are going to have an example. So the example goes, Pearl of Africa Limited manufacturers building materials, manufactures building materials and sells them to retailers, corporate and individual customers directly through their field sales staff. You're an auditor in Manpower and Company responsible for the audit of Pearl for the period ended 31st December 2012. You are currently reviewing documentation of Pearl's internal control in preparation of the internal audit. Customers order goods through the field sales staff and directly at the factory. So when sales staff receive orders, they do not check for their availability. So when you're reading such a question, you first underline anything that is negative. So customers do not check the availability of goods at the factory and warehouse. So you underline that. Then full payment is made in advance by customers before the dispatch of goods. So they pay for the goods before receiving them. Then goods are dispatched via company transporters. However, they do not record customer signatures. So you also underline that. Anything that is negative, they do not always record customer signatures as proof that the customer has received goods. So over the past 12 months, there have been complaints about the delay between sales orders and receipt of goods. So you also underline that there is a complaint, something negative. Then Pearl has investigated this and found that in each case, sales orders had been entered into the system correctly but was not forwarded to dispatch department for fulfilling. So when the sales orders were entered in the sales system, they were not sent to the dispatch department for fulfilling. So you also underline that. Then Pearl's corporate customers undergo credit checks prior to being accepted, and credit limits are set accordingly by the sales ledger clerks. So these customers place their orders through one of the sales team who decides on their discount levels. So required, they want us to, in respect of the internal control of Pearl, identify and explain 5 deficiencies. Like deficiency is something that is wrong. What is wrong with the system? Have you identified anything wrong? So identify and explain 5 deficiencies, then recommend a control to address those deficiencies, like what they can do about that. Then describe a test of control that the auditor can use to assess those controls that you've identified. So that's the question. So we start answering it. So we are going to draw a table showing deficiency, control, and then test of control. But in the paper, unless they have told you to draw a table, don't draw a table. You write a deficiency, its control, and test of controls. Unless if they have specified that draw a table. So this is how we are going to answer our question. We are going to mention a deficiency, like something that is wrong with the system. Then the controls that management can use to address this deficiency. Then the test of controls that the auditor can use to test if this control is working properly. So we first identify the deficiency. The deficiency is something that is wrong and you get it from the question. For the rest, you don't get them from the question, but for the deficiency, you get it from the question. Yeah, what is not in the question, do not put it there. So according to the question, they said the field sales staff, they do not check the availability of the goods before accepting orders. Like they just accept orders before checking whether they have goods in the store or not. So this may result into them accepting orders when they do not have goods in the store. Like it's you maybe you're selling phones, you accept an order of a phone without checking if it is real there in the store. So it may lead to you accepting orders but you do not actually have stock. So this can lead to you losing sales and then your goodwill because customers will not trust you again. Yeah, so that is a deficiency, something that is wrong. Yeah, it was there in the question. So they do not check the availability of goods before accepting orders, so it may lead to them accepting orders when there is actually no stock in the store or in the warehouse. So they may end up losing out sales and their goodwill. So what control can be used to address this particular deficiency? So the control that can be used here, the control is like a device. How can they overcome this? Yeah, the field staff do not check the availability before accepting orders. So the control can be the field staff should always check the availability of the goods in the store before accepting orders. And then for those that are not available, they should ask customers to give them time to get what they actually want. So that's the control that can be put in place. They should always check before accepting orders. Yeah, so the test of controls, how can the auditor test this to see if they are actually putting it into practice? So the auditor can test this particular control by selecting a sample of orders that were received by the sales staff and check whether the goods ordered were available in the store by that time. And if they were not available, the auditor should check if customers were informed of the waiting time. That's how this can be tested. So as I told you, you just twist the control and come up with a test of control. So here the field staff should always check the availability. So here the auditor will select a sample of orders that were made by sales staff to check whether the goods ordered were available in the store by the time they were ordered. And if they were not available, to check if customers were informed of the waiting time. So that's how we do it. You get the deficiency from the question, then the control is something like a device to management. Then you twist the control to come up with a test of control. So I'm going to put the next answers. I'm running out of time. I'm going to put the next answers. You'll be able to see them. Yeah, and in case of any questions, please ask. Thanks for watching. Let's catch up in my next video. That was all about the cell system.